Good day, everyone. My name is Ryan Paradina, a master's student from Mapua University, taking Engineering Management program. I am here to present you our research paper titled A Portfolio Selection Using Safety First Model for US Blue Chips and Top 30 Companies under NYSE List during COVID-19. To begin with, this is the walkthrough of the presentation. Here is the paper presentation outline. We will start on introduction, followed by the methodology. The third is the results discussion, then fourth is the conclusion part. At the end of this presentation, we will do question and answer if there's any. Introduction. In our world today, it has never before seen a pandemic like the one we are experiencing in the first quarter of 2020 up to present. COVID-19 disease has surely impacted the whole world, not only speaking of health and death, but also greatly impacted the economy and business statuses of each country. Due to this situation, there are doubts and instability around both the future of the economy as a global and facing personal financial situations. One of the most affected investment regions is the US stock market situation is having this impact. However, in most recent news, there is still hope to invest stocks in US given the pandemic crisis. The US economy in 2020 was still stable despite the concern on the US-China trade war. This resulted to informing the changing annual list of best stocks to buy according to the US news and some stocks that are flat-footed. Thus, if the interest rates near zero, the stock market remains a long-term financial capability for Americans. According to US News and World Report, it presented 10 best stocks to invest in 2020. These are Medifast, Alibaba, Nexstar, AbbVie, and so on. This means that the US stock market is still the one of the best to invest. It also means the US indices are still trading, and for investors, this is a big driver for long-term picture which surely can be probed. The purpose of this study is to provide the reader about the US stock market using the top 30 company stocks to invest in 2020 and including the pandemic situation, and have information from the status of these companies to where to invest with. This paper will contribute to a reader or investor to expand the learning and have knowledge on US stock market based on the data collected, presented, and analyzed. The reason of choosing top 30 is based on the blue chip stocks wherein these companies are proven well established and secure. It also imparts a high posting and dividends history with earning profits. This is because of a strong and well managed by the executive team of each company imposing financial and operations strategy so that their revenue will continue to grow. Such investors will think that their investment is secure and will have earnings. Methodology. This section discusses the investment pool, return estimates, and selection of the portfolio. All the stock data has been downloaded in the website of Yahoo Finance starting September 11, 2017 up to September 18, 2020. The consideration of these dates was based on the COVID-19 and pre-COVID-19 period with 132 dates backtesting using the historical returns as estimate for the next period performance. A fear factor QS, hope factor QP, and omega with a budget of 200,000 US dollars is set by the researcher acting as the investor. When the omega is 1, it means the investor is purely hopeful, and 0 if purely fearful. For this study, we set the omega to 1, which means we consider a purely hopeful investor. The researcher conducted a study among the top 30 companies in the US stock market, as shown in Table 1. These companies are also considered as part of the blue chips list. Three different benchmark markets have been used only to observe and have a good comparison with the companies and will use their estimate return data. These are NYSE Composite Index, Dow Jones, and S&P 500. The reason of choosing these markets is because it is common and one of the most popular markets in the US. After identifying the investment pool and using the historical returns as proxy for return estimates, it is now time to generate a portfolio selection model to determine an optimal portfolio. For this study, the selection model used a safety-first approach. It will maximize expected return at the same time limit the probability of having a threshold loss, or RL, to a specified probability. The investor aims to lower the risk with a fixed threshold return. The common safety-first model according to equations 1 and 2, wherein RP is the portfolio return, the threshold loss RL, and threshold probability beta. Equation 2 means the lower side of the risk of the portfolio and limited to the threshold beta probability. In this part, you will see that the scenario of returns R1J, R2J, RPJ, and RAJ as the asset A return on scenario J. The nominal weight probability denotes as PJ. If the portfolio return on scenario J is RPJ, we can say RPA equals summation of XA RAJ from A equals to 1 to K. This will give us the following equations 3 to 7 as the scenario-based SF portfolio selection model. From these formulas, we can determine the equation 3 is relative to equation 1 because it maximizes the portfolio return. The equation 4 provides us how to calculate the portfolio returns given the scenarios. Equation 2 is the reflection of equations 5 and 6, which means we can now know the probability threshold of losing the RL at certain probability beta. Results. This section contains description of the data and the results of backtesting dates. 3.1 Data Description. The stock data used are downloaded through Yahoo Finance indicating the closing market indices. The data covers that all the dates from September 11, 2017 up to September 18, 2020. These dates show pre-COVID-19 and COVID-19 dates. The data in the initial pool are the blue chips US companies top 30 stocks under New York Stock Exchange list. All portfolio utilizes the past 500 days historical data as return scenarios to estimate returns of the portfolio for the 132 days backtesting period. The safety-first model used on the 5 portfolios with fear and hope level set to 3 and omega of 0, denoted by P-0, P-1, the NYSE market portfolio as N, and the Dow Jones market portfolio D, and the S&P 500 as S. The safety first parameters used are RL equals negative 5% and gamma equals 5% and alpha equals 1. P-0 denotes the portfolio for purely fearful, while P-1 denotes the portfolio for purely hopeful investor. The respective portfolios are backtesting using the backtest days within March to September 2020. Each of the output returns was gathered and tabulated in Table 2 to show and obtain the portfolio graph in order to determine if it can outperform the market, and from this to find portfolios that can outperform the markets. It contains mean daily return, standard deviation, and cumulative return. Based on the simulation results, P-0 means no return, no loss, and no portfolio. So we focus on the comparison of P-1 with NYSE, Dow Jones, and S&P 500. P-1 portfolio is superior in terms of mean daily return, standard deviation, and cumulative return as it has 0.0025, 0.0282, and 0.3279 respectively. It is also obvious and observed in Figure 1, the cumulative return is outperforming the market. Furthermore, for a more accurate test, pair t-test is applied on the pair return difference of P-1 with the markets. Table 3 shows us the hypotheses are null hypothesis, no significant difference, and alternative hypothesis, the difference is greater than 0, and thus give us that there is not enough evidence to show the portfolio outperforms the benchmark markets, S&P, and Dow Jones, but against NYSE, it is very close to being significant. This can be further validated to have longer test period above 132 days consideration since the pandemic COVID-19 days are not yet over. In summary, based on the comparison of P-1 to markets NYSE, Dow Jones, and S&P 500, it is observed that behavior of stocks during COVID-19 pandemic dates P-1 outperforms the market in terms of mean daily return and cumulative returns as supported by the backtest results. From these results, we know that P-1 can outperform the market and can possibly lead to alternative investment options. The investor will have a chance to earn a profit in this way. Conclusion. At the end of this study, the daily returns of portfolio P-1 is close to being significantly larger than the NYSE market returns. This means that on average, the return portfolio is higher than the portfolio of the benchmark markets at a given day. This is during the pandemic COVID-19 period dates. During these times, the investor should be purely hopeful in order to earn profit. The set parameters are purely hopeful because of the set parameters QS and hope QP set to 3 and omega is 1. For future research and study, it can use parameters like the omega is zero point 0.1, zero point 0.2, or zero point 0.9. This way, all the type of investor can be considered. Also, for future study, these can be still explored and find optimal portfolio selection to invest. During this pandemic, we should be hopeful to invest on the identified investment pool above. It can be noted that we as investors can still invest given the set of parameters under the pandemic days. In summary, based on the comparison of P-1 to markets NYSE, Dow Jones, and S&P 500, it is observed that behavior of stocks during the COVID-19 pandemic days P-1 outperforms the market in terms of simulation and backtest results. From these results, we know that P-1 can outperform the benchmark markets and can possibly lead to alternative investment options. The investor will have a chance to earn a profit in this way. This is now the end of the presentation. Thank you for listening. The floor is now open for question and answer.